After last week's video, a few of you may be wondering about how the travails at home are going. The toe is still broke and painful. I've got some claw marks here on my face because my 2-year-old does not understand the rules of a tickle fight. And last night, baby Isla shared a milestone moment with me shortly after bath time that resulted in a full wardrobe change for me. So that's how it's going on the home front. But while I'm safe here in my office, this week we're going to cover how investors can stay safe during the turbulent times that they're facing. To listen to the news media and to listen to the punditry, perhaps it's your neighbor who's fascinated with this. It's all about making a call when it comes to investing. And sadly, these people, that thought that predominates so much of market talk these days, really loses sight of what are the roots of investing. And as simple as it sounds, it's so critical. And it's this, that at the end of the day, when you're investing in a stock, you're really investing in a company with the hope of sharing in either presently or in the future, their future profits. If you're lending that company money in the form of a bond, you of course want to get paid an interest payment. And I say this is lost because of two reasons. Number one is the importance of income, of cash flow, whether that's coming to you in the form of a dividend payout or a bond payment. It's a huge part of investing. For stocks, the majority of the S&P 500's return historically has come through dividend payments. Of course, bond payments, the return you hope to get for the most part is whatever that interest rate that's tied to that particular fixed income instrument, none of which has anything to do with market timing. And in fact, when you really dig into that power of income, so much of the pressures of trying to time markets or make the great call, you realize not only is it not productive, it's counterproductive. So we're going to look at a few things today, areas where investors might be able to find yield, and then dig a little bit deeper in terms of how the power of income reflects that and some other things to keep in mind. So where can clients find income in a world of pretty low interest rates? With respect to equities, global equities present a tremendous opportunity. Janice Henderson put out a great piece that will be cited below, where they looked at how are global dividends doing. And as of Q1 of this year, as we're just wrapping up not too long ago, dividends are already up 10% year over year to just under 1.4 trillion for the year. They're on pace for the total calendar year to grow by about 8.5%. And so this, again, is one great area lost by a lot of people who get really fixated on individual securities or maybe even an individual sector of the market that they could be missing out on, that has proven over time to, again, be a huge component of total return itself, but also a very resilient way to get income and return through volatile markets. Dividends, unlike those share prices, don't have the same measure of volatility. And just because a share value is dropping doesn't mean the dividends connected to that stock may drop at all, which is, again, something that surprises a lot of people. Some other areas where we think investors should be spending a little bit more time looking are high yield bonds, are bank loans, some parts of the global bond market. You can still get, in many cases, over a 5% income stream. And historically, high yield bonds, those bank loans, have given equity-like return with a lot less risk. And there's a great piece that we'll cite from Alliance Bernstein that talks about just that phenomenon. Here's the other part about the power of income with respect to bonds. Two great charts that I love to cite with clients and others. One was put out by Bain Capital, where they looked at this power of income and really looked at an investor within the context, of an investor who could have timed the market perfectly, gotten in when valuations were cheap, gotten out when they got expensive. And what they found was, even if you did that, even if you were able to buy and sell at those correct times, the income you would have lost by being out of the bond market over the last 27 years would have created such a drag that you actually would have underperformed that bondholder that stayed invested the entire time. So again, as I alluded to earlier, not only would timing of the market not helped you, it actually would have been counterproductive. American Century put out a great piece a few years ago that looked at it from a slightly different angle, but brought the same point. As we talked about last week, so many investors are afraid of interest rates going up. And while it's true that it can create an initial drop in value, that ability to reinvest at higher interest rates actually can be very accretive, positive for an account value. They looked at a study where you had a 5% rise in rates from about a 3% yield level. And while it did create an initial drop of about 20%, you're back to even within 3.5 years, which is a lot quicker than your typical stock market drop. But more importantly, over a 10-year time frame, you would have had about a 30% greater gain than had interest rates not moved up. So tough in the short term, absolutely. But in the long term, again, actually a more beneficial thing for investors. As we talked about last week, how do you pull all this together? How do you find those great global equities? How do you find those managers that can help you navigate these bond markets? Because again, I get it. We don't want for our clients to see those 20% type drops alluded to within the American Century approach. And that's where active management can become so critical. If we look at some of the bond managers we work with who are very adept at shrinking their energy exposure a few years ago, they didn't get hit on their high yield bond exposure the same way as people who were just buying an indice or just indiscriminately trying to buy things based off the highest interest rate and yield. A lot of thought went into that. And again, research would show you, certainly we found that active management with respect to that bond component or that global equity component can be very beneficial and typically tends to outperform many of their passive counterparts. With that, we're going to wrap things up. But again, remember the importance of income, remember the roots of investing, and take heart with the fact that with that well-constructed portfolio, not only can you hopefully retire earlier by getting more income, but have a safer retirement as well by the power that income and yield can bring to a portfolio. Thanks so much.